Hello, this is a comparative analysis between Costco and Target Corporation by Adam Ching and Crystal Costa. Here we can see Target's ownership summary. They have 655 million shares outstanding, and 82% of those are from institutional ownerships. Some of the top institutional ownerships for Target are State Street Global at 9.3%, Vanguard Group at 4.9%, and MFS at 4.2%. As we can see from this chart, almost 33% of Target's ownership come from 10 of the top institutional holders. Here we can see Costco's ownership summary. They have 432 million shares outstanding and a slightly less institutional ownership of only 77%. Here we can see Costco's ownership summary from institutional owners. Some of Costco's top institutional owners are Capital World Service at 6.8%, Davis Selected at 4.7%, and Vanguard Group at 4.3%. Costco's ownership is slightly less from the top 10 companies at 31.8%, whereas Target had almost 33% ownership in the top 10 institutional owners. Both Target and Costco are owned by financial investment companies. Such differences in the types of ownerships would show potential investors that such financial owners are more aware of the flourishing companies that give a higher earnings per share versus an owner in another industry. Although financial institutions have the cash flows to gain ownership in a corporation, they are also knowledgeable in the investment industry. This provides potential investors with positive reinforcement to invest their money with these companies. Based on the number of institutions willing to invest in Target at 1,001 positions versus Costco's 893, Target's a better choice to invest in versus Costco due to a higher share scale. So why do investors care about capital structure? Capital structure refers to the percentage of capital in use for a given company. Generally speaking, there are two forms of capital: equity and debt. Equity capital is essentially money that is put up and owned by the shareholders. This type of equity can be categorized into two types: contributed, which is money originally invested in the business in exchange for shares, and retained earnings, which represents profits from previous years. The most profitable balance between equity and capital and debt capital is the optimal capital structure for the company. In terms of debt, Costco has a debt ratio of 7.3% versus Target's 30.8%. Costco has a firm value of $47.7 billion and the current cost of capital at 2.72%. The optimal debt ratio is 20%, which would reduce their cost of capital to 2.6% and increase the firm value to $49 billion. On the other hand, Target has a firm value of $61 billion and a current cost of capital of 4.8%. Their optimal debt ratio being 60%, which would reduce their cost of capital to 4.1% and increase their firm value to $64 billion. Tax rate. When a corporation has a higher tax rate, they also have a higher tax savings, which results in higher optimal debt ratio. The current tax rate for Target is 34.27%, and their optimal debt ratio is 60%. Costco, on the other hand, has a tax rate of 35.3% with an optimal debt ratio of 20%. Optimally, Costco could incur more debt to take advantage of additional tax savings, but prefers to decrease the probability of default or bankruptcy, as well as lower the value of the firm. The ability to pay back interest on debt can be calculated by the coverage ratio, which takes a corporation's EBIT and divides it by their interest expense for a given period. The higher the coverage ratio, the greater chance a corporation will be able to pay back interest on debt. When the interest coverage ratio is below 1.5, it results in the inability to acquire enough revenue to sufficiently support interest expense. The interest coverage ratio for Target is 5.3%, whereas interest coverage ratio for Costco is 15.03. Although both these companies generate enough revenue to pay back interest on debt, Costco is a much better position than Target to take on more debt. So who's the preferred company based on capital structure? Costco Wholesale is considered more favorable than Target based on numerous factors. The interest coverage ratio for Target is 5.3, whereas Costco is 15. The debt ratio for Costco is also significantly lower than Target at 7.3%, while Target has a debt ratio of nearly 31%. A low debt ratio allows for firms to acquire more debt in the future to invest in projects or to expand. The bond rating of Costco, as well as its default spread, is also better than Target at AAA rating versus A rating, and the spread difference of 0.75% puts Costco in the lead. The pre-tax cost of debt financing for Costco and Target in this analysis is calculated by adding the default spread to the current long-term government rate of 1.77%. This is also the same as the interest rate based upon rating according to Professor DeModron's capital structure worksheet. The default spread for Costco Wholesale and Target is divided by applying each corporation's recent S&P credit rating to the default spread table for large manufacturing firms and retrieving the corresponding default spread value. The default spread value can be found by Professor DeModron's capital structure worksheet. The pre-tax cost of financing for Costco is estimated to be 2.42%, while Target's is 3.17%. The after-tax cost of debt is estimated by reducing the pre-tax cost of debt by the tax rate of each corporation. For both Costco and Target, a 5-year average effective rate is used in this analysis instead of a marginal tax rate. Target's average effective tax rate of 36.2% yields a 2.4% tax cost of debt. Costco has an average of 36% and yields a 1.54% after-tax cost of debt. So who's the preferred company based on cost of debt financing? After looking at the cost of debt before and after tax, both Costco and Target, Costco is a more appealing company due to a low pre-tax cost of financing of 2.4% compared to 3.17%. Costco also has a lower after-tax cost of debt of 1.54% compared to Target's 2.41%. Costco has less debt than Target, and their cost of debt financing is going to be lower. Cost of equity financing. Beta is a key component of the capital asset pricing model, or CAPM, which is used to calculate cost of equity. The table below shows the published beta values for Target and Costco. Target's beta values range between 0.43 and 0.88, while Costco's range from 0.49 to 0.69. When comparing both Target and Costco's cost of equity, Costco is more attractive than Target due to having lower cost of equity financing. When it comes to comparing betas, Target has a slightly lower beta, which puts it ahead of Costco. When taking these two variables into consideration, it's still more important to have a lower cost of equity because equity is the most expensive form of debt financing. The overall cost of capital. This table shows market capitalization, equity and debt ratios, and cost of capital, as well as the weighted average cost of capital, or the WACC. In comparing Target and Costco, total number of shares, Target has significantly higher volume of shares and shares outstanding. Target has 692 million total number of shares and 654 million shares outstanding versus Costco's 441 million total number of shares and 432 million outstanding. As you can see in market value of debt, Costco has significantly lower market value of debt at 1.25 billion versus Target's nearly 13.7 billion. Alternatively, Costco has a higher market value of equity of 44 billion, whereas Target only has 42 billion. Neither company has preferred stock, so those numbers were not calculated in determining WACC. Both companies use more equity than debt to finance their operations. However, Costco has an equity to capitalization ratio of 97.24%, which indicates they are not utilizing the benefit of debt, which would save them significantly when paying taxes. Comparing this to Target's capital structure, Target has an advantage. Lastly, Costco has a much lower WACC than Target does, which indicates Costco is able to finance at a lower rate. Overall, Costco is much more appealing than Target due to their capital structure advantage. So who's the preferred company based on overall cost of capital? Based on the information comparing Target and Costco's WACC, Costco Wholesale has a lower cost of debt, cost of equity, debt ratio, and equity ratio. So overall, Costco is financially a better company compared to Target. How would a financial restructuring affect the value of our company? Financial restructuring not only includes changing a corporation's financial structure, but also changing ownership, control, or business portfolio. The purpose of financial restructuring is to increase a corporation's value, which includes reorganizing financial assets in order to create the most financially beneficial environment. The best corporation to use as an example would be Costco, for the mere reason that Costco could acquire more debt without causing an increase in default. Optimal debt ratio is calculated by analyzing the cost of capital. At optimal debt, both Target and Costco have low average cost of capital, about half. According to the debt ratio table, if Costco increased debt to 50%, their beta would also increase to 1. The downfall in this is a bond rating much lower than acceptable according to the firm value. This would also conflict with the capital structure diagram of Costco, where to increase debt at such a high rate of 50%. Optimal cost of capital for Costco is already 4.15%, with a current 4.33%. Any more debt would add to the cost of capital and devalue the firm. If the corporation were to increase debt any amount lower than 50%, they would still hold a high enough bond rating in the long run than another corporation like Target. The preferred company based on financial restructuring. In the instance of financial restructuring, both corporations could use a change in ownership, more directed at management style. When it comes to changing or updating a business portfolio, Costco could increase their value by improved capital restructuring, while adding debt to expand or innovate new ideas. Based on the diagrams alone and choosing the corporation that would best suit financial restructuring would have to be a tie. I believe Target and Costco could reorganize their portfolios to manage debt and cost of capital, which would lower their WACC percent. So would more debt create an unnecessary risk? Both companies have debt ratios well below their optimal levels. Some of the advantages of carrying more debt or operating at optimal debt ratio could include tax savings, added discipline, increase in a corporation's value, and increase in their beta. When a corporation acquires more debt, so does an increase in interest expense, which is tax deductible. This is a huge attraction for corporations thinking about expanding or innovating. With any advantage, there are always going to be disadvantages. If Target and Costco increase debt to an excessive amount, they would expect to see higher bankruptcy costs because the probability of default is much higher when cash flows are volatile. It's clear from the analysis of the capital structure of both companies that more debt would create an unnecessary risk. Both companies operate in an industry with higher rates of return as compared to other industries in different segments of the market. Every corporation needs flexibility in the future, and so the optimal debt ratio should be lower to allow for future borrowings. So what do the competitors do? Target Corporation's biggest competitor is Macy's, which is a high retail sales department store that sells a variety of home goods, clothes, and accessories. When comparing Macy's and Target, there is a significant difference in a couple key statistics, including stock price, beta, EPS, and debt-to-equity ratios. Macy's has a stock price much lower than Target, with a $27 difference. Both these stocks would be considered low stocks in the sense that the stock price is below $100. Macy's has an EPS price at 3.14 compared to Target's 4.36. In this case, Target would be the more attractive company to buy. When looking at companies' betas, the amount of debt a company has reflects the beta rating. For Macy's, which has a beta of 0.98, which is really close to 1, and anything over 1 being too risky to invest in, this beta reflects the ability for the company to make payments on interest as well as a high default risk. Target, on the other hand, maintains their risk and debt with a beta of 0.64. When looking at each company's market cap, there is a huge spread between Target and Macy's at $42.83 billion. These two companies might be considered competitors, but according to comparisons, Target's not only a better financially stable company, it also manages debt and equity sufficiently on a larger scale. Costco, on the other hand, their biggest competitor is Walmart. Not only does Walmart have retail stores, but has a different segment within the company that closely relates to Costco called Sam's Club. Sam's Club is a warehouse retailer set up the same way as Costco to provide customers with goods in bulk. This table shows a comparison between the two companies. When looking at this diagram, Walmart is a larger company in comparison to Costco. This could be due to the fact that Walmart also caters to a retail and the warehouse side, while Costco only has one segment. In every variable above, Walmart stores manages not only a large market cap, it also takes in much more revenue than Costco. Walmart being such a large company, an investor would expect a higher stock price and a higher cost of debt as well as beta. Costco actually has a stock price higher than Walmart at $102 compared to 74.75. With Costco having minimal risk, their beta is much higher than Walmart at 0.4. Overall, Walmart might be a bigger company, but I feel Costco's financials are more stable and less risky. So is our stock price fairly valued? Depending on the industry and market, a stock price of a company can rise and fall quickly or slowly. A fairly valued stock can be defined by a perceived value to the market price. Answering this question based on all the information gathered would just be one investor's opinion. An opinion that compares the stock price of Costco and Target to its competitors is the best way of knowing if a stock is fairly valued. The only way this comparison would not work is if a company was compared to another corporation that held more than 50% of the market's demand. For example, Apple. In this instance, Apple cannot be compared to another company like HP because HP doesn't control more than 50% of the market. Apple does. After taking this into consideration, both Costco and Target have a stock price that is fairly valued given the demand and market for the retail and consumer goods industry. So in conclusion, after reviewing Costco Corporation's and Target Corporation's financial data, Costco is a more financially stable company and also less risky than Target, which most investors would feel more confident investing in. Thank you for taking the time to listen to our presentation.